Good morning, good afternoon, good evening, depending where you are on the planet. And welcome to today's Tuesday, the 7th of February, Bull versus Bear webinar. Steve Miley on the call for trade day. Welcome, everyone. Going to go through a slightly different setup for Tuesday, given that this is like a synthetic pseudo Monday, given we didn't have the webinar yesterday. So I'm going to run through the shape of the week today, but there's not a lot to go through because it's a fairly quiet data week. Quick recap of last week. Look ahead to what the balance of this week, and then focusing on what we've got today. Look at the major news wires, what's impacting markets right here, right now. Take a look at the charts. So for the quick recap for last week, we had that massive week, right? Fed rate decision, hike, perception of a slightly more dovish tone from Powell. Absolutely not. I don't think he actually delivered that, but that's what the markets took from it anyway last week. We also had relatively dovish reactions to the European Central Bank and the Bank of England last week. The Bank of England certainly did a slight dovish step. The ECB, if anything, tried to do a hawkish step and the market took it dovish. Mega cap stops outside of Meta. Meta very positive. Apple, Amazon, Alphabet, all very negative. And then we had that massive non-farm payroll number, 517,000, showing a really strong labour market still. Unemployment fell to 3.4%, its lowest level since 1969 in the US. And the ISM data as well, the non-manufacturing PMI jumped to 55.2 from 49.2 in December, way above consensus. But European S&P global numbers were slightly worse than it. Oh, that's why they broadly beat estimates as well. Sorry. So data stays super strong. Perception is market is now worried about, and we've certainly got this in here, like Citibank today. So Citigroup, prepare for the risk to rates hit 6%, right? The Fed's telling us 5%. What's the curve pricing in? Well, the curve's pricing in, remember, if we go to the middle of, we've got 5 to 5.25 in here now. So, we're pricing in here for us to go up. This is actually slightly increased in here, right? So previously we were looking at, we'd already had this 25. We were looking at now at the next meeting another 25, and then potentially for on hold at that point, up to 475. 500, and then we were looking for potentially on hold. Now we've got 500, 525, so another 50 from here. So the market is now pricing in peak where the Fed's telling us, right? They're saying around 5%, right? So the market wasn't pricing this in. It now is pricing it in, but it is looking at 500, 525, the peak. You look, we go back to September, it's still there, but the market's still pricing in. Look, 500, 525 peak. This is November, but a growing chance of a rate cut. And then definitely a rate cut by the end of the year, 475, 500. So the market's still pricing in rate cuts. Key today, I'll come to it shortly, is we've got Powell speaking today, right? At the Economics Society, whatever it is, in Washington, D.C., Economics Club. And, critical today is what his kind of guidance is. Because recent Fed speakers in here, and I can't remember who it was yesterday. Let me see if this got in 5 things to start your day. Yes, it was Bostic. Said January's strong report raises the possibility the central bank will need to increase rates to a higher peak than policymakers previously expected. So a higher peak, he's already talking about a higher peak. So if you're talking about a higher peak, it's unlikely that we're going to be getting rate cuts if they're talking about a higher peak. We might get rate cuts if they go to a higher peak, but certainly the market now, he reiterated his base rate for rates to reach 5.1 in line with the median of policymakers. Okay. But that's what we're pricing in now, right? So the CME curve, we are pricing in rates to the 5.25 zone. Okay, so that's exactly what the market is pricing in. We weren't pricing that in. Remember, we were pricing in 475 to 500. So the market got ahead of itself, was kind of behind the curve. The Fed was ahead of the curve, if anything. The market was more dovish and the Fed was hawkish. But now the market's kind of in line with the Fed, but the risk of growing that we could go higher, and the market is still pricing in that rate cut. So I think today could be really key. Last week was critical. The market came through that. It was choppy, Yes, the mega cap disappointments from Apple was Amazon and Alphabet didn't help on Friday. And yes, what should be like a positive number, the employment report, is taken as a negative number because it means the Fed can be more aggressive. So, markets was negative on that. But overall, we're still up, right? We're still up net on the week last week. And then even though we dropped again slightly yesterday, we're still very close to the recent multi-month highs. So we're staying broadly risk on, okay, on a short to intermediate term outlook. But we'll zoom in and see what the chart looks like for the day trades today. In fact, we're so risk on. The FTSE 100, that's the UK benchmark index, hit a record high. And that's being helped by the fact that the pound is remaining very weak in here, okay? Looking ahead to this week, you can see it's really light on the calendar. In fact, today is the key outcome really for this week is Powell speaking. Later on in the week, but we've got UK GDP, we've got nothing significant until Friday, US Michigan consumer sentiment. That's kind of it from the US. We've got nothing of real note. German CPI could be interesting. Just incidentally, RBA rate decision. Overnight, the RBA hiked as anticipated, 25 basis points. However, they definitely had a significant shift to more hawkish, saying that rates could go higher than the market's expecting in here. No upward limit in here at the moment from the RBA, and that's the Australian dollar strengthening overnight last night. So bear that in mind. Yeah, other central banks are taking that step to more hawkish. Okay. And obviously, we didn't quite get that last week, and the market didn't interpret that last week. But the curve is going back to in here. We are looking at peak rates in here higher than where they were. If I go in now and say for September, look at the historical on the 500 to 525, and this does annoy me that we have to do this every time. Why they can't just have a deselect button, I don't know. If anyone finds a deselect button, please write in. But look, we've been sitting in here. The 500 to 525 was down at only a 20% chance in it, oscillating between like sub 20%. This is for the September meeting to like the peak sub 40%, and now we are like a 45% chance. Okay, so we've seen a far more aggressive move since the employment report, not since the Fed. Is the employment report has given the green light to rates going higher, potentially going higher. So yeah. That's been a significant move. So the kind of more in line with what the Fed has been telling us from the curve. But I think today will be interesting. So just going through 5 things today. Say Bostic was slightly more aggressive in here. We also had risk off yesterday because this balloon, the shooting down of the Chinese balloon in here. Obviously, it could cause issues with respect to trade war, with respect to foreign policy, with US China. So that's not good. Markets don't like instability; they like stability. Credit Suisse bonuses have been delayed. Doesn't really affect us. S&P futures slight bounce after yesterday's decline in here, and all eyes on Fed Powell. And sorry, it was no. So we've got this later as well. Michael Barr, Fed Vice Chair for Supervision. Michael Barr is speaking as well. But I think all eyes on Powell this afternoon. And if we go to the calendar in here, we have it here. So it's at 12:40 Eastern time today. We also have other speakers from central bank. Schnabel from the ECB, and Bank of Canada Governor is also speaking just after Powell as well. So if you're trading the Canadian dollar, watch out for fireworks. You've got both Powell and BOC Governor McClem is also speaking. Other than that, it's a light calendar, okay, but that's going to be critical, waiting for Powell today. And so the market could be a little bit sidelined up to Powell. So just running through a few headlines in here, we said, in here, look, so, the markets probably needs to beware that peak rates could be a lot higher, according to Citigroup. We've also had BP data in here, soaring oil and gas prices boosting. No surprise in here. We've seen it on the US reporters as well last week. So BCB hiked its dividend, extended share buybacks, another record profit in here for BP. What else do I have in here? Another article on here. Reuters, BP makes record profit in 2022, boosted by oil spending. A few other things. ChatGPT in here. I don't know if you guys are aware of this, but ChatGPT is helping Chinese AI and technology stocks leap higher through the ChatGPT mania. Powell's State of the Union. So it's not actually the State of the Union, is it? Oh, it is like State of the Union address. Is it State of the Union address today? I thought we were just speaking. Okay, State of the Union address in here. Is that what they're calling it, or is that actually what it is? I'm not sure. Let's have a look, see what this article says. State of the Union, yeah. Oh no, sorry, President Biden's State of the Union address. Okay, right, okay, that's what I was going to say. We don't get that, right? State of the Union. So why has it got POW? Why is it saying that there for POW? I don't know. Oh, while excuse me. Powell's State of the Union. Okay, while US President Joe Biden gets to deliver his second State of the Union just later on Tuesday, well, markets will be more into of yes. All right, sorry, my confusion in there. I mean, that's just I don't know. Why are they doing that? That's just confusing. Right? Powell's State of the Union, right? I've been doing this a long time. There's no way the Fed governor does any kind of State of the Union. It's just an interview today, right? Yeah, at the Economics Club or Society in Washington, D.C. But it's basically reiterating that this is more important than what Powell's got to say for markets. Sorry for the confusion, but I don't know whether this is lazy journalism, sensationalism journalism, but caught me off guard there. Futures inch higher ahead of Powell's speech. Yeah, it's all going to be about Powell. Oil is up. Oil rise in China outlook and also supply worries. Turkish earthquake not really impacting markets other than oil slightly impacting oil. We've got FTSE slightly higher. Other European exchanges pretty much flat today. 2/10 down on the DAX, the German index. French index is pretty much unchanged. And if we go and look at US in here, obviously we saw notable declines yesterday. Pretty much unchanged going into this morning. All right, let's have a look at a few charts. So we'll start off in here. I'm going to switch to the S&P first of all. So notable declines Friday and Monday, but not aggressive, super aggressive in here. That was on the back of then it was Thursday, right? So let me just double check these are the right. Yeah, Friday and there. So Thursday we had this potential shooting star. It did end up coming out as a shooting star pattern in here, but we read it. But look, this is where we were pre the Fed. Okay, this is the Fed day. Okay, last Wednesday. So we're still up post Fed. Thursday we had the declines, and then Friday we're down after payroll. And remember Thursday we sold off from peaks after the mega cap. The mega cap data came out. That was Thursday evening post market. That's what created that shooting star. Friday the market then bounced and sold off. Excuse me. Oh, sorry guys. Big sneeze. So we fold off, but it wasn't super aggressive after the very strong US employment report. And yesterday tracked lower, both in the wake of the US employment report and the shooting down of the balloon. Who would have thought, well, we've been talking about balloons impacting markets in here. We've got this kind of tentative trend line that runs across here. Okay, comes up through this low. We pierced it here. It's not the best trend line in the world, but nevertheless, I'm going to redraw it actually. So I'm going to put on these trend lines in here. Let me get rid of this Fibonacci. Let's redraw this trend line in here. Okay, so I'm going to take it through here and then through that low there, and then we're going to extend it out. And I'm going to do it as a ray and apply and save. Okay, so you get it extend there. So you can see we're back flirting with it. We pierced down through it here. Okay, rebound from it here on Fed Day. This was last Tuesday. Rebounding from it and flirting with it now. Okay, even if then I redraw it off the lows, then we're going to be notably above it, right? If I draw it through the actual lows, through here and through the Tuesday low there. Okay, so we're holding a significantly above there. Also note the 13-day exponential moving average here, the green line. Look, pierce down through there, notably above that. For me, this says like the short-term trend is still up. Doesn't mean it goes up today, obviously, and we're day trading at trade day, but nevertheless, we've also, if you look at yesterday's price action, dip and a rebound right off that trend line, the old trend line that we broke, we've pierced that and rebounded. So for me, the underlying theme remains positive in here. So I'm still looking for this to bounce and looking for a bit of upside. Okay, particularly after how we closed yesterday. Okay, so slight negatives were indicated. If we go back to, actually, I don't want to go back to the my daily, because if I go back to the daily in here, it'll only screw matters up in here. So I'm not going to do that, but I'll come back to talk about that a bit later. But yeah, the market inside at the moment, no surprises, but a decent rebound yesterday. If we step into 15-minute chart in here, okay, so there's the spike up last week. Significant rally in here. This is on Fed Day, I think. Yeah, that was post-Fed. Okay, and then we've been chopping down lower, but still defending, still higher. This is Fed Day, still higher than where we were through the Fed. Okay, and if we look at the post-Fed rally, I'm going to put a Fibonacci retracement actually, let me get this all on the same page in here of what we've done. Post-Fed in here, look, we're holding right around the 61.8. So this is the post-Fed rally, okay? And if you look, we're holding around the 61.8 and trying to base in here. I wouldn't be wanting to go long right here, right now. I think I want qualification. You've got multiple failure peaks in here around 41.36.5, 41.37, okay? Up through 41.6.5, maybe as high as 41.41 in here signals this is a better basing pattern, and I'd be looking for upside. So looking to buy through there. If it takes out this little kind of basing trend line we have running across here, oops. If it takes out this, then I'm probably looking to short it down through there. So shorting down through 41.15, 41.13 kind of area on the downside. Looks more bullish through 41.37.38. And that's my bias, is to be long in here. And similar tale for the NASDAQ in here, obviously declined, but look, there's the post-Fed rally boom in here. It wasn't a significantly down day yesterday. So, and look, even on the payroll day, so we had that shooting star pattern on the Thursday. Then you have the payroll day. We're inside, and we only just broke below Thursday's low yesterday, and now trying to bounce again. So kind of quite resilient in here from the NASDAQ. Again, it'd be the same lines in here. I'll be looking at this kind of little basing line across here, and then really back above. I would say really I want it back above that peak there, and through there 12,580.25 up through there. It looks more bullish, so looking for the break there, and then we could be back at the highs, up towards the highs. We could be up at 12,800, 850, 800 to 850 easily on the S&P today post, and then again it's all going to be on power. And if we go to look at the S&P, so that was on the NASDAQ. If we go look at the S&P, we could be up into here, maybe 41.70, 41.80, okay? But Powell could easily strike a more hawkish tone. If he does that, it's going to be sayonara. It's going to be significantly lower. So we're certainly watching for all of that. Right, let's take a look at golden oil in here. Make sure I've got the right contacts. We should be on, Jay's right. Yeah, I'm pretty sure. March, April, HJ. Yeah, we're on J. April contract in here for gold. So dead cat bounce, significant sell-off in here last 2 days from Friday through Thursday through Friday in here. Dead cat bounce, low level consolidation yesterday in here, and looks very negative for me in here. Flag pattern, yeah. So you get sell off, flag, sell off, another flag, yeah. Looking for the breakout. If you want to be more aggressive on the downside, you look for a push down through there. Look, we're holding right there now. Down through 1878 looks more negative. Now, sometimes flag patterns do reverse the other way. If you're aggressively bullish, you're looking up through like 1889, 1890. If you want to wait a little bit, 1894 on the top side. Okay, but looking for the resolution of this. Chances are bearish, but don't fight it if it goes the other way. And let's have a look at oil. Oil in here had a decent rebound, challenging this downtrend line there. I'm going to zoom in and take a look at that in a second. Did get below this support, holding above the low for the year and rebounding, but sort of fading a little bit in here. I think it's a little tricky on this one with oil. So if here we look at the downtrend line in here for oil, coming across here, you can see flirt with it there, failing there. I mean, this is a real tricky one. I've got no strong view. I think you have to wait and see how this plays out really in here. So it's already breaking down. I mean, you'd be bearish, right? It's fading at that trend line. So hanging on to more of a bearish tone in here for oil. It's faded right where it should have faded. Look, it pierced that trend line before. I'm drawing the trend line through here. Get rid of that. So look, oh gosh. So look, draw us through here. So this is the peak from the 27th of January, and then the peak from the, what day is that? That's the 1st of February, and then it pierces on the 3rd of February and fouls today, and it's pushing back down. If you get a qualification down through, I would say, this little swing low here, down through 74.71, this looks more negative, and I think it's a good play. And then you're basically just cutting above the. So I think you can be short through 74.71, and then you can go short and reverse above 76.05. Above 76.05, shoot for 74.71, looking for a move back to the lows. So staying bearish, clinging to a bearishness on oil. Any questions? Anyone want to look at anything else? Anything you guys need? Nope. type away. Always very quiet. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Do take care, stay safe, and I'll be back with you with another bull versus bear webinar. Actually, just before I go, do check the might bring the webinar slightly forward, slightly earlier tomorrow. So do check the streams, the heads up, and check the forum. Might be slightly earlier webinar tomorrow, but check that out.